Hey everybody, this is Naveen David Meager. I'm a financial consultant and founder of ProfitSpear Consulting. And today I'll be walking you through a simplified cash flow forecasting model for your business. I've been doing this for 15 plus years with big Fortune 500 companies as well as small companies. And so today I'll just spend another 5 minutes just walking you through basics of a cash flow forecasting model. And I also can provide you this free template. Just go ahead and request that on my website. You can even download it by clicking on the link. And if you have any questions, you can set up a free consultation and we can go over the forecasting model just specifically designed for your business. All right, so let's dive into the cash flow forecast model. This is a simplified 12-month cash flow model. And as you can see, if you want to, include more columns, if you want to make it a 3-year model, 2-year model, or if you want to make it a weekly model, just go ahead and insert the appropriate, columns wherever you want it to. But this is designed for a simplified 12-month cash projection. So again, on the top is where you have the cash coming in. Again, all the highlighted cells that you see are cells where you need to put your inputs. If it's not appropriate for you, if it's not related to your business, just go ahead and make it a 0. But all the highlighted yellow sections is where you need to put inputs. So top is all cash inflows, bottom is all cash outflows. Then you have the net cash position that it shows you each month, and it shows you cash on hand. And this also shows you if you have a minimum threshold for your business in terms of, let's say, you want to have $10,000 of cash in your business at all times, then you can put that reserve level here. And this is going to tell you if you need to raise additional cash. For example, in month 1 and 2, you really don't need to raise cash. But in month 3 and after, you are now running out of cash. So you need to raise some cash. And for that, you also have a section down below which will allow you to go ahead and raise cash either from a bank loan or a credit line of credit or any investor equity, and you can inject cash into your business from these sources in a particular given month. And it's this model is going to calculate what is going to be the implication of that. So how much is the interest going to be, how much, how is it going to impact your cash position each month. And it can also show you when can you pay it off, so that you can come back, you can have no debt on your books, so to speak. So let's start from the beginning. So go ahead and input your cash on hand in the first section up here on the top. Once you do that, go ahead and include all of the cash coming in from sales, from any other sources of income, from any kind of outstanding invoices out there, accounts receivables, any sales of assets, any shipping revenues, anything like that. Go ahead and include that. And if there is something that you think is unique to your business, go ahead and insert a column, insert a row, and go ahead and put that particular line item there. Then scroll down is cash outflows. This is where all your cash payments that are going out, right? The rents, payroll, vendor payments, purchase orders, suppliers, marketing, and so on and so forth, right? Once you put all your expected expenses, then you can also include anything that's coming from cash that's going on for any kind of expansion. So if you're buying some equipment or expanding or redoing your store, real estate expenses, building something new, you can go ahead and put that in expenses as well here for cash projected out, right? Any kind of tax related payments, expenses, or any dividends or payouts to the owners, you can also include that here. So this is all the cash outflows. So then this is going to tell you that what is the net cash position. Now this example, this is telling me that the net cash is going to be negative 10,000 the first month. Why? Because you brought in less than than you spent. As a result, your net cash on hand has come down from 40,000 at the beginning of the period to down to 40,000 because your net cash was negative 10,000. All right. So then this is showing you what is your cash position on hand each month. So what this you can see is that after month 2, in month 3, you're actually running out of cash. So based on your sales projections that you have and the expenses that you're planning to do, spend, you are now going to be running out of money in month 3. Okay, and you'll probably be in a hole for the next 3 to 4 months, and then slowly come out of it. And then again towards the holidays, you'll again be back on track, but you'll be having some cash crunch issues during the year. So to avoid this, either you can go ahead and increase your sales projections, reduce your expenses. Maybe you can shift your vendor payments, or renegotiate rents or things like that, just to figure out how to make sure that this number turns positive on line 47. The other thing you can do is you can just go ahead and raise some cash, right? You can just say, okay, I need $50,000 to be out of the hole and above my threshold in month 3. So I'm going to go ahead and raise $55,000 in month 3, right? So month 2, sorry, because you need it in month 3. So I will go ahead and put $55,000 that I need to borrow. What's the interest rate from the bank? and I will also include select the month that will be injecting this cash into my business. Okay, so once you do that, you can see that your total cash on hand will be positive, as well as you will no longer be in a cash crunch. Okay, for at least for the next 8 months. But again, in month 10, you'll have another issue because you're running out of cash there. So maybe we should raise some more cash in month 9. So I'm going to go ahead and raise additional $25,000 in month 9, and from using a line of credit or a credit card or something like that, which is going to be a, I don't know, 12% interest rate. Change that if you think it's higher or lower, right? And then what it'll do is it'll basically say, okay, I'm going to inject this cash into your business, and I'm going to calculate what is your debt payments going to be, what are interest payments going to be, and I'm going to roll that back into your business, into your cash flow projections. Okay, so with that, what is the impact of your cash on hand then? So it shows you that your cash on hand is still very, above the threshold that you want, and you'll never have a situation where you're running out of cash. Got it? And then also in month 9 and 10, or 11 and 12, looks like this business is very seasonal, or has a lot more sales in the holiday season. Therefore, you can afford to go ahead and pay some of the debts back out and pay those debts. So in month 11, you can go ahead and close out this loan, and you can see that the loan balance is calculated automatically. And month 11, you're at $43,000 loan balance. You go ahead and pay that off because you got a lot of sales coming in. And as well as you can go ahead and pay that credit card loan out or a line of credit off in month 12 because you have cash on hand. So once you do that, it's going to reflect that into your cash position. And it will show you that once you pay off all your debts, and how you're able to smooth out your cash position based on when you borrow cash and when you pay it off. As a result, you're not really getting cash too soon from a bank and paying additional interest on that. So this will help you to smoothen out your cash projections, smoothen out your cash flow situation, and make sure that you're in cash positive all the time. If you have any questions, let us know, and happy to help out. You can set up a consultation or send us an email, and we're happy to help you out. All right, thank you.